Is Amazon stock a bargain? We're talking about Amzn stock. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. Amazon stock is coming under pressure, losing around 10% of its value in the last 24 hours, nearly 8% after hours following their second quarter 2024 earnings. And yet, looking at the fundamentals, not too bad. I mean, let's look at North America. Operating profits improved significantly from $3 billion last year to over $5 billion. So you see margin improvement. You're seeing international going from a loss to profit. Even though it's a small profit, it's better than a loss. You're seeing a huge improvement in AWS operating income going from $5 billion to $9.3 billion. So broadly, this looks great. I mean, why is it coming under pressure? One aspect is that, yes, they beat EPS expectations, but they missed in terms of Wall Street revenue expectations and what Wall Street expected, and broadly looking at the different business lines. And you can see this is the detailed layers in terms of their revenue drivers from online stores, physical stores, third-party seller services, advertising revenue, subscription, AWS, and other. There was only one of those business lines that actually accelerated during the quarter. The rest saw a significant deceleration. And whenever you're seeing a deceleration, it sort of gives investors concern. And, you can see how online store sales went from 7% to 6% growth, physical store sales 6% to 4% growth, third-party services 16 to 13, advertising, a noticeable slowdown as well from 24% to 20%. So you're seeing this sort of deceleration in the business. So that is sort of a concern that investors are mindful of. Maybe it has to do with a weaker economy. We'll talk about that in a second. That said, it seems like management's doing the right things to win business for the long term. And they talk about why they're winning, because their AWS business did seem like it actually reaccelerated. This was one of the few business lines where it's like, wow, this is actually quite good. Where AWS, so this is one of their business segments, I should say, their growth went from 17% in the first quarter to nearly 19% in the second quarter. And they talked about, the reason why is that previously some of their customers had been trying to do some sort of cost optimization. And now they're saying, look, we've gone through the cost optimization, and now it's about, modernizing their infrastructure and the tailwind of moving from on-premise to the cloud, that's resuming. And so their previous initiatives of, hey, how do we manage our expenses and let's cut back on our cloud bill is now focused on, we need to focus on the investment in terms of growing this business and building stability for the future. And that sort of tailwind, that's been a multi-year, multi-decade tailwind. They also talked about how they're enabling, companies of all sizes to benefit ultimately from AI as well, where they're talking about, you can run Claude, you could run Llama, so you could run, and they're making it readily accessible, so that way, if you don't want to run, let's say, OpenAI, you can run some of these other AI models and easily embed it in your business application. So that's a big aspect of, what's driving AWS. And I think, looking at the business holistically, management does seem to be focused on Jeff Bezos described this really well years ago, and I have one of the books on him over there, where it's, some people, he was asked, what's going to change in the next 12 months or next 5 years? And the way he framed it, he inverted it, as Charlie Munger likes to say. It's always inversion, where he said, try to figure out what's not going to change over the next 5 years. Are customers going to want higher prices? No, they're going to want lower prices. Are customers going to want slower service? No, they're going to want faster service. So focus on the things that aren't going to change, and you're going to do fine. And I think that playbook just continues. Look at the benefits that they're rolling out for Prime, where Grubhub Plus is now free with Prime. So this is making it easier for people to place takeout orders, getting food directly on Amazon. So that should help, drive their business. They're talking about how this is exactly what I was just talking about. Speeds for Prime members in terms of getting packages. It's never been faster. And I've noticed that myself, where, now I'm starting to see more and more items where, it's like, do you want it tonight or do you want it tomorrow morning? And it's like, wow, that's fantastic. That type of turnaround. So you are seeing, the investments, I'd argue, starting to pay off. So the question is, well, what are the thoughts on Amazon in terms of the valuation, given these dynamics where, you see margins broadly improving, sales not delivering what arguably investors want to see, a deceleration, concerns. So how do you factor all that into thinking about the valuation, whether or not it's a bargain? And in context, I just did 2 prior videos. My last 2 videos were companies where I said, hey, the stocks have sold off. This was on SoFi and Lulu. I don't own any. But I said, hey, their valuations are at points where I go, it looks interesting. It looks quite compelling. So you can check out those videos. So most of the time I do give the thumbs down or sideways, just to keep, be mindful. So I'm curious, how does Amazon fare? First, in full disclosure, this is not financial advice. Also, quick plug, recently an Unrivaled Investing subscriber posted in our exclusive Discord, this is a direct quote, "I've recently paid my 2nd annual subscription and couldn't be happier. I've profited enough already to cover the next 20 years of subscriptions. It's not hyperbole. I actually did the math. So if you're looking for compelling investment ideas, come check out unrivaledinvesting.com. I think one of the reasons why Wall Street's getting a little nervous around Amazon, and I think you're broadly starting to see it with the market, at least the last couple of days, with some significant volatility. Not crazy volatility, just significant when you're seeing the up or down 1% to 2% in a day. It's just, you notice it's, animal spirits are starting to get a little, And I think part of it is this concern that, hey, maybe there's something going on with the consumer. Because you're talking about disappointing 3rd quarter guidance and management saying, yeah, we acknowledge that we came a little short on revenue growth in North America. Yes, their profit margins were better than expected, but their top line isn't growing what they'd like, partly because consumers are choosing to buy cheaper products, leading to lower average selling prices. So this is the disciplined consumer, and the direct quote is they're continuing to be cautious in their spending and trading down to lower average selling prices, ASP products. That's super important, to be mindful of. And this is the environment. Consumers have sort of struggled with inflation. And so they're sort of saying, do I actually need this? Or can I, instead of buying the Heinz ketchup, can I buy the Amazon Prime version, Amazon Basic version? And, would that be just as good? So I'm thinking about the valuation. First of all, it's incredible. Management has pounded the table for decades that their focus is on building cash flow per share. And it's incredible to see the free cash flow per share. It's incredible to see them go from 10 billion cash burn as of the 1st quarter of 2023. This is on an annualized basis, to $50 billion in free cash flow, positive free cash flow, as of the 2nd quarter of 2024. So that's just an incredible margin, pulling the levers to get that free cash flow. And so I think it's important to reflect, like, wow, I don't think you're going to expect them in the near term to go from 50 to, let's say, $100 billion. I think this is probably closer to where it's appropriate for their business. But at $50 billion versus the $170 share price, which reflects this nearly 10% drop in the last 24 hours, that's a $1.8 trillion market cap. So $1.8 trillion market cap versus $50 billion, that's still 36 times trailing free cash flow. And so I ask you, is that compelling for a business that's growing sales, 10% on a consolidated basis? Personally, I don't think so. For example, one of my top positions, it's a company growing 20 to 30% a year and trades at 16 times free cash flow. So more than double the growth rate and less than half the valuation. And that's 16 times free cash flow. So it's tough for me to say, like, this is super compelling, but I'm going to, I like to have multiple perspectives. So I go to AI Ticker Chat. And by the way, we just launched new chat. So it's completely upgraded and it's completely free. So if you have any questions about any US stocks, we cover the vast majority of US stocks. It's above like a $200 million market cap, $300 million market cap, around there. Any of those US companies, if you own them, feel free to just chat, ask away at AI Ticker Chat, completely free to use. That's leveraging some of the most cutting edge AI models. So that way it pulls from the transcripts, the financials, whatever questions you have to dive into it. So I'm using one of the premium features for paid users, which is the predict feature, to say, hey, how can Amazon perform over time? AI is reading the documents, taking a guess on, what the revenue growth could be in the future, what the margins could be, what the multiples could be in the future. And it's broadly saying, meh, maybe over 100% upside over the next 5 years, maybe, 40% downside over the next 5 years. So it's not that compelling, but I personally would want to tweak some of these assumptions, because in some cases I think they're too high, in some cases I think they're too low. So for my own personal tweaked assumptions, I'm giving them more credit in terms of revenue. So I'm tweaking that from a 10 to 15% annual range. I'm also tweaking the margins on the low side to be a little bit higher, 7.5%, 10%, and 12.5%. And I'm tweaking the end multiples down quite a bit, because I think 50 times just for 10% growth, or even a little bit faster growth, just isn't appropriate. Even though they clearly are unrivaled, I'm assuming around 30, 35 times earnings multiple for the consolidated business. And that gets to, I'd argue, it's just not a super compelling picture. So I'd argue even after this sell-off for Amazon, it's still not quite in bargain territory, even though it's nice to see the stock, drop and you go, okay, is this a time where I want to pull the trigger? Because it's clearly improving their value proposition, faster delivery, people love the service. But I think it's a combination of, you have recessionary impulses with the consumer just starting to show up, possibly, we'll see, and arguably not a crazy cheap valuation. If this were trading at, there's another e-commerce play that I own that's growing much, much faster than them. I actually just wrote about it for my subscribers earlier today, growing much, much faster than them. And a few months ago, I was able to buy it at 30 times free cash flow. So it was a lower multiple and growing multiples faster. So I think people just love Amazon because it is unrivaled, but the valuation, it's just kind of rich. It's maybe rich is too strong a word. Maybe I should just say it seems full or fair, and there's a chance that you could have multiple compression because, let's say high 30s free cash flow multiple, why couldn't that be 30 times? Why couldn't that be 25 times? And I suspect it could be. I could be wrong about this, and I'd definitely welcome your feedback in the comments below. Thanks so much for watching Unrivaled Investing.